for long-term investors, what you want to see from somebody like John Deere this early in a recovery cycle is what we would call incremental profits, somewhere around the 30%. So you're dropping all those increased sales into profits. And today, Deere reported about 21% incrementals on their agricultural equipment. So it does raise a question. If you're this early in the cycle and you can't deliver on the profits, then, you know, what's a long-term investor supposed to do from here?
I don't know. Is there more than one reason why they only did 21% there? Is it input costs, or what else is it?
Yeah, no, I think you nailed it there. It's higher steel prices, and it's also higher freight costs. It's suppliers in the supply chain trying to catch up, because when you have demand strong in agriculture and construction and all of these other end markets that some of our other companies supply into, it's hard for suppliers to ramp up this quickly.
I mean, would you start to look at the overall, at the broad stock market itself and say, wow, consumer confidence is great, business confidence is great, but eventually costs are going to be going up and margins are going to be squeezed? I mean, is there some type of broader theme that you can see here? Should we be worried?
Yeah, we write about that quite frequently, actually. If we look at input costs rising for the group and we look at pricing power hasn't really kept up with input costs, and that's hurt a number of companies in our coverage. You know, we're getting incremental squeezed, and that's the death march for a deep value, long-only investor when they're looking at cyclicals.
Anne, you just took the question right out of my mouth. This is Morgan Brennan, by the way. Is pricing? Because I know last quarter Deere talked about the potential to raise prices. Is that something that's still going to play out moving forward? And if so, how much room do they really have to do that, especially if you see something like tariffs really, truly impact commodity prices?
Yeah, great question. And that is going to be one of the key questions we have for management when we get on the conference call a little later. If you look at their construction business, they noted that one of the items that hurt their margins was indeed higher sales incentives. So, you know, there is a struggle out there to maintain market share, to keep your volumes going through your factories, and still try to offset some of these higher input costs. So it's a tricky balance for management, and one that investors care a lot about. So we are seeing bifurcation across different industries. Some industries are able to get pricing, some industries are not.
It's another, there's too much of a good thing. I'm reading, it's truck drivers shortage too. They're paying higher priced expedited options because of the truck driver shortage. Higher prices, logistical challenges, all factoring into it. And today, there's a piece in the Journal, we're going to make the trucks longer, which scares me because, when it goes by, I'm already sort of turning into it. And it's like, whoa, there's another one.
I avoid the truck lanes whenever possible.
Right. So
that's exactly right. If you're at the peak of the cycle or you're in the sweet spot of demand and you can't get pricing power at this point in the cycle, then you're never going to get it. And that's the concern that investors have in these cyclical stocks.